G'day, guys. It's Wala here. I stumbled upon this today and I had to retweet it. I thought, is this bad? You know, what sort of interpretation is this? And I think it's hard to read between the lines, but I think that it's a net positive. And I think that, like, last week I posted a video about Alan Kohler talking about the Bitcoin halving, and some people were like, I don't really think he understands what's going on. But I actually do think that he's quite on touch, in quite on the topic actually, in touch, on top, whatever. Um, so I came across this article and I had to read, and I figure I'm just going to read it out to you because it's an interesting one. It's an interesting one. So, Alan Kohler. Um, Bitcoin is not a Ponzi bubble, it's worse. It's an insurrection. Dated March 6, 2024, and it's posted on the new daily.com.au. So, okay. The price of a Bitcoin briefly hit a record high this week, and in Australian dollars, it went above 100,000 for the first time. When it crashed 75% in 2022, a lot of people felt vindicated, and many were inclined to predict, perhaps a bit too gleefully on reflection, that it would go to zero. That seemed reasonable. Bitcoins are digital ephemera created from nothing and good for nothing. It seemed obvious the whole thing was a scam, a Ponzi scheme, or a bubble, or a bubble. Well, inconveniently, the price started rising again as 2023 began, and having tripled in a year, it's back to where it was. The bursting of the Bitcoin Ponzi bubble will have to wait, maybe next time. Actually, it'll never go to zero, and the skeptics are doomed to be perpetually perplexed. Bitcoin will probably crash again, but is neither a Ponzi scheme nor a bubble. It's something far worse. It is an inherently secure, tightly controlled asset with a regulated supply, and is therefore subversion to the whole basis of the free market financial capitalism. Ponzi's and the bubbles are a normal part of the system that allow regulators to tighten their largely ineffective control, but a security that regulates itself, that's an insurrection. Inflation, then halving. This is the fourth big Bitcoin inflation, and it coincides with the fourth halving that takes place next month, probably on April 19, which also happens to be the 40th anniversary of Advanced Australia Fair becoming our national anthem, whatever that matters at all. The four previous Bitcoin bubbles began, like this one, about a year before each of the previous halvings in 2012 and 2016, 2020, and ended a year after them. The one due next month is having the same effect, and it's being amplified by the creation of a series of ETFs by Wall Street investment houses that allow investors to buy Bitcoins more easily. That is, without having a mysterious digital wallet and deal with one of those crypto exchanges. Inflows into the ETFs are running at more than 600 million US per day, and BlackRock's iShares Bitcoin Trust has become the fastest ever ETF to reach 10 billion. It seems reasonable to assume the price will go a lot higher this time than the previous peak, as those ETFs try to buy Bitcoins they must when the supply is limited and about to get even more limited. The halving is where the computing power required to mine Bitcoins yields half as many units as it did before. The process was established by the inventor of bitcoins. He keeps on saying bitcoins when we actually don't even put the S on the end. It's always Bitcoin, even when it's plural. Satoshi Nakamoto, which is assumed to be a pseudonym, although nobody knows for sure. When they created the Genesis block, that is the first lot of bitcoins on January 3rd, 2009, along with a cryptic note that said, the Times, 3rd of Jan 2009, Chancellor on the brink of second bailout for banks, though to explain why they did it. Thought to explain why they did it. They had published a white paper titled Bitcoin, a peer-to-peer electronic cash system, on a cryptography mailing list on October, and kicked off the blockchain with the Genesis block of 50 bitcoins 2 months later. Bitcoin mining is designed to maintain the blockchain and involves spending vast amounts of computing power, therefore electricity. So, most miners are located up near cheap power that is usually, but not always, renewable. The miners have a group. The miners have to group and broadcast new transactions into blocks, which are then verified by the network. Each block must contain proof of work that is designed by Satoshi Nakamoto and involves finding a nonce, an arbitrary number used in cryptography. To cut short a long, complicated story, it is very hard to do, but it works fine as a business if you get organized. For example, Australian Bitcoin miner Iris Energy mined 341 Bitcoin in January at an average electricity cost of about 18,000 US per Bitcoin, and it sold them for an average of about 42,000 each. So a gross profit margin of 56%. With the price now 50% higher, and if electricity costs the same, the margin would now be 70%, assuming the same cost of electricity. Tightly controlled asset. There are 3 ways in which the Bitcoin system is inherently regulated, not by any government or central banks, but only by an inbuilt design that can't be changed. First, the difficulty of generating a block, basically a box of data, is adjusted based on mining power on the network by recalibrating the difficulty target every 2016 blocks, which is about every 2 weeks, to maintain the average time of 10 minutes between new blocks. Second, the reward is halved every 21,000 blocks, or about every 4 years. At first, each block produced 50 bitcoins, and then in 2012, it shrank to 25. In 2016, 12.5, then 6.25 in 2020. And on April 19 this year, it will be cut to 3.125. And third, this will happen until a total of 21 million bitcoins will be reached, after which that's it. No more can be mined. That's due to happen in 2140. This, I submit, makes bitcoins the most tightly controlled financial asset to man. It continually becomes scarcer until a preset limit is reached. Other securities like bonds and shares can be issued by companies and governments at will, as long as they do the paperwork. And as for money, well, since the Federal Reserve Board was created in 1913, so many US dollars have been issued that its purchasing power has declined by about 97%. As for where Bitcoin will end up and what its place in society will be, will it become a means of transaction, a store of wealth, or just a plaything for speculators? I have no idea, but I'm reminded of the gag by Chinese Premier Zhou Enlai in 1972. When asked what he thought the impact of the French Revolution would be, he answered, It's too early to tell. Actually, he was apparently referring to the Paris riots of 1968, not the 1789 revolution. But that's not as good a story. Bitcoin has been going for 15 years. Paper money was invented in China in the 11th century, and Marco Polo brought the idea back to Europe. Merchants used promissory notes until governments started taking over the promises in 1668 with the creation of the Swedish Riksbank, followed by the Bank of England in 1694. In 1816, Thomas Jefferson declared that banking establishments are more dangerous than standing armies, and that the principle of spending money to be paid by prosperity under the name of funding is but swindling futurity. That's a new word I haven't seen before. On a large scale. It was proved right many times. In 1892, 1907, 1929, 1982, 1989, and 2008. So Bitcoin might look like a Ponzi bubble because its price is volatile and it seems to be in the grip of speculators and scam artists. But in fact, it may be the only thing that isn't one. So, yeah, very interesting article from Alan where he basically is unearthing the idea that most fiat currencies seem to be backed by nothing and that they can get printed by out of control. And he's clearly seeing that that the internal regulation inside Bitcoin is so tight and so well restricted that it is the pin that can pop the fiat bubbles. So steady as she goes. If you keep the ball rolling, eventually, there's no doubt everything probably will be steamrolled eventually. It's going to put a lot. I sometimes call it the blowtorch to most fiat currencies because I have to admit, only just last night, the what was it? The Egyptian pound. I think lost like somewhere between 34 to 50% depending on who's speaking. Because they decided to open the market up for free trading and basically said, you guys go out there and pick the value for it. So they lost 34+% of their value. I'm happy to just stay in Bitcoin. That's a good idea. All right. Thanks for listening. Like and subscribe, I guess. See you later.